I still look at in my broad commodity outlook that gold's probably going to remain one of the best performers. It's certainly typically over time, it has been outperforming most other commodities, most notably copper on a 1 to 5, 10, maybe 20-year basis, depending certainly on a total return basis. But overall, I think the key thing is the bottom line for gold to really put distance above $2,000 an ounce and move much higher is I think you're going to need the U.S. stock market people to start to realize, okay, it probably can go down and we probably will have a recession, something we haven't had. I mean, and stay down.
MikeMcGlone, a top commodity strategy expert, currently holds the position of Senior Commodity Strategist at Bloomberg Intelligence. MikeMcGlone observes a divergence in gold investment patterns as certain investors are selling gold ETFs while central banks, notably China, rapidly accumulate gold, as reported by the World Gold Council. Putting this observation into context, gold exchange-traded funds have experienced a decline this year after a 13% gain in 2024, as indicated by the performance of the GLD. Nevertheless, gold prices have maintained levels above $2,000, attributed to geopolitical tensions and expectations of lower interest rates, which have provided support to gold bullion. While adding more depth to this narrative, data reveals that Chinese gold purchases surged by 30% in 2023. The country's central bank strategically acquired gold to replace its dollar holdings amid tensions with the U.S. Simultaneously, individual investors sought the safe haven appeal of gold as economic uncertainties unfolded. This data establishes a comprehensive picture of the evolving dynamics in gold investment, from investor behavior to central bank strategies and global economic influences. In terms of the broader commodity outlook, Mike predicts gold will continue to excel, historically outshining commodities, including copper. According to an analysis by the World Gold Council, gold outperformed emerging market stocks, U.S. bonds, the U.S. dollar, global treasuries, and commodities in general. He predicts that gold is ready for a significant upward move towards $3,000, with the key catalyst being a reversal in ETF flows towards inflows. Despite gold's current stability above $2,000 an ounce lacking strong bullish momentum, Citi forecasts significant growth potential for the metal, with a possibility of reaching $3,000 per ounce in 12 to 18 months under a bullish scenario, while expecting an average of $2,150 in late 2024 as a base case. Furthermore, he emphasizes the significant role of gold in global currency holdings, making up to 12%, while observing a gradual increase in its prominence. Now, we present the clips of MikeMcGlone's insights from his recent interview with SOAR Financially. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Investors have been selling gold, ETF investors, but the deepest pockets on the planet have been buying, central banks, most notably China, have been buying gold at a colossal pace, according to the World Gold Council. I do enjoy a lot of their reports. I've been on their distribution list for at least a decade, their quarterly reports. And China is the largest buyer. The significance for that is, I think, it's looking forward to just a little bit of normal back and fill in the U.S. stock market that's apparently unstoppable. Just a little bit potential that all this recession leanings we had last year, which was too extreme and didn't happen. And now the leanings this year are towards soft landing. It's not going to have a recession. And the Fed's going to ease. That's just starting to tilt back a little bit. To me, that's going to be a story this year. So I still look at in my broad commodity outlook that gold's probably going to remain one of the best performers. It's certainly typically over time, it has been outperforming most other commodities, most notably copper on a 1 to 5, 10, maybe 20-year basis, depending certainly on a total return basis. But overall, I think the key thing is the bottom line for gold to really put distance above $2,000 an ounce and move much higher is I think you're going to need the U.S. stock market people to start to realize, okay, it probably can go down and we probably will have a recession, something we haven't had. I mean, and stay down. We haven't had since bottom in 2009. That's a long time. Oh, we've had these little corrections and the Fed comes in and saves you, but that's what's changed now. The Fed's just not going to ease with the ease they have in the past, particularly because of all the inflation they created with too much liquidity. So it was meant to be rhetorical, but so I'll end with this. The key thing about gold is I think gold's ready to, at some point, it had at least one dip below 2000 this year. We all kind of had to expect that. It might get more, it might make it as difficult as possible, but at some point I think it's going to start off on a launch pad and head towards 3000. I don't know the timing, but I do know what the key catalyst will be is to get those ETF flows to tilt towards inflows. Total ETF holdings have dropped to 83 million ounces. That's the same as January 2020. I mean, that's 4 years ago. Yet, so we've had this period of gold going up and ETF outflows, which is very rare. So I think that's going to flip at some point. And just the point of the question was, well, for U.S. investors who have to keep up with indices and who, if you're a money manager or if you're a wealth advisor and if you get fired if you don't keep up the stock index, you just need a little flip in that. It's going to happen. It always does, where people start to give up in the stock market for a little while for a normal recession. And then I think gold will really win. But I have to end with this. If you look at the central banks buying, but most of the central banks buying are the axis of bad guys, of which China decided to go that way, which is still the shock to the system. I've learned from economists in the last century or so, if you wanted to become wealthy in a country, it goes up to the United States. Well, they just tilted the wrong way. Certainly some of it. I think as far as global holdings of currencies, there's the dollar, there's the euro, and then there's gold. The top three, gold is maybe 10 to 12%, and it's increasing. But the large holding of gold in the world I've seen them at the Federal Reserve Bank in New York, and it's U.S. Government. But I still think you got to be careful of the world. That's a book I read recently called Capitalism Without Capital, about the whole tilt towards intangible assets, i.e., obviously, what's the most significant on the planet? The U.S. stock market and crypto assets and things like that. And there's probably going to be a correction, but in a modern world, a very financially astute, advanced world, is still, I think it's the advance towards more intangible assets, which the U.S. and most of the rest of the world is going for in digital. And then the old guard, like Russia and China, are going for old guard gold.
MikeMcGlone predicts a continued trend of de-dollarization and sees buying gold as a rational response to geopolitical uncertainties. Indeed, in the absence of any other contender for reserve currency status, countries diversifying away from the dollar have opted for gold. Accordingly, central banks have been buying gold at record rates in recent years, with the People's Bank of China leading the way. Regarding the leading driver for gold, Mike highlights the downturn of the U.S. stock market's performance. History shows that while the stock market declined, gold rebounded and ended the year up 5.5%. During the 18-month stock market sell-off, gold rose more than 25%, emphasizing that gold can be a great buying opportunity even in the face of initial declines. Let's get back to the interview.
If you're underweight equities and overweight gold, you've been way underperforming. And also there's this pretty significant cost benefit analysis of 5% T-bills in the U.S., the highest in 15, almost 20 years.
I think it was 23 years at some point. Yeah.
Well, there you go. So those are all bad for gold, and it makes sense. There's ETF outflows, but what does not make sense is the gold price of gold holding up. And I think that's significant because the physical buyers, number one, China, and kind of the bad guys of the world. China's tilted towards kind of the bad guys: Russia, North Korea, Iran, and there's many other buyers, but I don't think that stops. And there's a pretty significant war going on. There's a lot of reasons to buy gold if there's a historical measure. But here's the key thing I really enjoy pointing out, Kai. We are in the middle of a paradigm shift in the world order, and that is China's, and I shouldn't say China, I'm sorry, with respect for China and its history. President Xi's tilt towards unlimited friendship with Vladimir Putin of Russia, two people of great countries, and they're just tilting their countries the wrong way. And that is where that buying of gold is holding up and makes sense. The de-dollarization, there's $300 million of Russian assets that have been seized by Western entities. And it makes a lot of sense that they would go to old guard gold. But I think the key leading indicator is going to be the U.S. stock market going down. I've been wrong. And that's why I just look at it's just teetering on just a little normal correction. I have little indications, like for instance, there's the S&P E-mini futures. I was at a hedge fund, used to trade those a lot. They have left the gap down to about 4,600. Just to put that in context, right now the price right now is 4,900, so about 9% below. That was back in December on this massive manic rally. It's never left a gap on a weekly chart since 1993. Never. It always goes back and fills them a few months later. So that's one of my little indicators. Of course, we have this U.S. election. I think the market's starting to price for the potential for a Trump presidency, the tariffs, drill at will in in energy and crude oil. But to me, there's a good reason. But now I think we're in that stage where it's one of those periods where if you're running money and you're not keeping up with the indices, you get fired because it's the frenzy. I remember seeing it in 2006, 7. I was early. I remember seeing it in 99, 2000. I was early then. And we just have never had historical backdrop for what we have now, which to me is most notably bullish for gold and very bad for commodities.
Since ancient times, gold has been the go-to investment for protection in times of uncertainty, whether economic hardship or security turmoil. Gold prices, like many other commodities, will always fluctuate. Do you see gold as a resilient investment in the face of economic uncertainties, or do you have other perspectives on its future trajectory? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.